The main benefit of active management versus, let's say, the calendar or passive, we would view that as almost like a passive approach, which could be two pronged. One is some of the buffered strategies, some of the hedged equity products that are maybe done quarterly, is that they are set and forget it, meaning that it's very transparent, which is the plus for those products at initiation, 3 months or 12 months in advance, what levels the strikes are at and how much you're giving away. Kind of the return path that will be deciding the payout of that product. The negative aspect of that is the consistency of your hedge is really varied throughout the year. What I mean by that is, let's say there's a product that says we're going to be hedging against a 10% move lower at initiation. Well, what happens if the markets drop 25% in the next 3 months? That means the downside protection is now 35% out of the money. Is that the same profile that you were initially buying into? Why 3 months ago or 6 months ago were you really interested against a 10% drawdown, but now it's a 35% drawdown? And conversely, if things go through the cap, meaning that they've kind of rallied very strongly, you're capped out, meaning that the product is going to look and feel kind of like a cash portfolio because it's already given away all the upside because it's gone through it. We think that being active in our approach, having a more consistent kind of profile over time is really more aligned with why investors were interested in the product to begin with. And then step two is we think we could add incremental performance because we could take advantage of market opportunities. One such example, we had a very strong year in calendar year 2023 and 2024 because volatility levels in the marketplace really declined a lot, meaning that the cost of protection on the downside was very inexpensive. What that allowed our product to do is sell away less of the upside to still pay for that downside protection, meaning that we weren't capped out like a lot of the competitor products. That's just kind of one example of taking advantage of kind of market opportunity. And so, in the last part is the buffered strategies as one example. Depending on which month you got into, and a lot of these products have, let's say, a January through January the following year, February through February the following year, and so on throughout the year, the products have extremely different return profiles over time from each other, even if they have the same rules. If it's just if the inception date or the strike date, the reset date was different, they could have very, very different types of performance throughout the year. If you're an advisor who has clients in multiple of these products, you might not even know when you're heading into a meeting if your product did well or did poorly, even if it had the same rules. Whereas our product, we think, is one that it's kind of and it has an approach that could be utilized throughout the year because it's not a specific month that you investor got into it. It's much more consistent in terms of its profile.